Hello everyone. In this video, we're going to talk about how financial markets work. If you're new to the world of finance, it can be a little intimidating to understand how markets move, but don't worry. In this video, we'll provide you with a basic guide to understanding how financial markets work. Part 1. What are financial markets? Financial markets are a term that refers to places where financial instruments, such as stocks, bonds, currencies, and other financial products, are bought and sold. These markets are vital to the economy, as they allow individuals, businesses, and governments to obtain financing and investors to make profits. But what exactly are financial markets, and how do they work? In simple terms, financial markets are places where buyers and sellers come together to exchange financial products. Financial markets are divided into two main categories: the primary market and the secondary market. Financial markets also include a wide range of other financial products, such as futures, options, and foreign exchange. These financial products are traded in specific markets and can be used by investors to protect themselves against risk or to make profits. Financial markets are important because they enable the economy to function effectively. Financial markets provide businesses and governments with the ability to obtain financing for projects and expansions, which drives economic growth. Investors can also profit by investing in financial markets, which allows them to increase their wealth and financial security. However, financial markets also have their risks. The prices of financial products can be volatile and can change rapidly due to external factors, such as the global economy, politics, and current events. In addition, investing in the financial market involves risk, and it is important that investors understand the risks and seek financial advice before investing. Financial markets are an essential part of the global economy and allow companies and governments to obtain financing and investors to earn profits. Financial markets can be a source of wealth and financial security, but they also carry risks, and it is important that investors understand the risks and seek financial advice before investing. Part 2. The primary market. The primary market is an important part of the overall financial system. This market is where companies and other entities issue new financial securities for the first time and sell them to investors. The primary market's main purpose is to provide companies and entities with the funds they need to finance their projects, expand their operations, or refinance their debt. The primary market is divided into two types of financial securities issues: public issues and private issues. Public issues are those in which financial securities are offered to the general public, while private issues are those in which financial securities are offered to a select group of investors, such as institutional investors or accredited investors. Public issues are usually made by companies that want to raise large amounts of capital to finance their operations or projects. These issues are usually regulated and require companies to meet certain requirements before they can issue their financial securities to the public. For example, companies that issue financial securities in the public market are usually required to provide financial and other information to potential investors before they can purchase the financial securities. Private issues, on the other hand, are used by smaller companies or those that do not want to comply with the regulations and requirements necessary to issue financial securities in the public market. These issues are usually aimed at more sophisticated investors and usually require a higher minimum investment than public issues. It is also used to issue new financial securities, such as government bonds, corporate bonds, stocks, and other financial products. These financial securities can be purchased by individual investors and companies wishing to invest in a variety of financial assets. Investors can purchase these financial securities through broker-dealers or directly from the company or entity that issued them. The primary market is an essential component of the overall financial system. It is the place where companies and other entities issue new financial securities for the first time and sell them to investors to finance their projects, expand their operations, or refinance their debt. Issues may be public or private, and the financial securities issued may include bonds, stocks, and other financial products. Investors can purchase these financial securities through broker-dealers or directly from the company or entity that issued them. Part 3. The secondary market. Secondary markets are a vital part of the global financial system. These markets allow investors to buy and sell financial securities after they have been issued in the primary market. The secondary market is where most of the buying and selling of stocks, bonds, currencies, and other financial products takes place. Secondary markets are important for several reasons. First, they allow for the liquidity of financial securities. Liquidity refers to the ease with which assets can be bought or sold. If there were no secondary market, investors would have to hold financial securities until maturity or until the company that issued them buys them back. This would limit investors' ability to obtain liquidity and to change their investment positions quickly. Second, secondary markets are important because they provide a market price for financial securities. The market price is based on supply and demand. If there are more buyers than sellers, the price will rise. If there are more sellers than buyers, the price will go down. The market price is important because it is a signal to investors about the value of financial securities. In addition, secondary markets are important because they can offer investment and portfolio diversification opportunities. Investors can choose from a wide range of financial securities and can buy and sell based on their investment objectives. Portfolio diversification can help reduce risk by spreading assets across different asset classes and sectors. They can be divided into two categories: organized markets and over-the-counter markets. Organized markets include stock exchanges, such as the New York Stock Exchange and the Tokyo Stock Exchange. These markets are highly regulated and have strict rules to ensure market integrity. Investors transact through brokers and dealers. On the other hand, over-the-counter, OTC, markets are markets in which investors trade directly with each other without the intermediation of a broker. OTC markets are less regulated and may be less transparent than organized markets. Secondary markets are an essential part of the global financial system. These markets enable liquidity of financial securities, provide a market price for financial securities, and offer investment opportunities and portfolio diversification. Secondary markets can be divided into two categories: organized markets and over-the-counter markets. Investors should understand the risks and benefits of secondary markets before investing and seek financial advice if they have any doubts. Part 4. Financial market participants. The financial market is a space where the buying and selling of financial instruments such as stocks, bonds, currencies, and other products takes place. This market is the heart of the global economy and is composed of a variety of participants who perform different roles to ensure the proper functioning of the market. In this article, we will analyze the main participants of the financial market. Investors are the main players in the financial market. They can be individuals, companies, banks, investment funds, and other entities that buy and sell financial securities in search of profits. Investors can operate in the market directly or through intermediaries, such as stockbrokers and asset managers. Investors can also be divided into different categories, such as retail investors, who are those who invest with their own funds, and institutional investors, who are those who manage large sums of money on behalf of third parties. Stockbrokers are intermediaries who facilitate the buying and selling of financial securities between investors. They act as agents for investors and charge a commission for each transaction they make. Stockbrokers can also provide financial advice to their clients and help them make informed investment decisions. Asset managers are companies that manage mutual funds and other investment products. They invest their clients' funds in a variety of financial securities and seek to maximize long-term returns. Asset managers can be divided into different categories, such as mutual funds, pension funds, and hedge funds. Issuing companies are those that issue financial securities in the primary market, such as stocks and bonds. These may be public or private companies seeking to raise funds to finance their operations or projects. Issuing companies can also be government entities that issue bonds to finance public debt. Investment banks are financial institutions that provide financial services to issuing companies and other market participants. They may assist companies in issuing financial securities in the primary market, provide financial advice, and conduct trading activities in financial securities. Regulators are government entities that oversee the financial market and ensure compliance with financial laws and regulations. These regulators may be national or international and have the power to take measures to prevent fraud, market manipulation, and other financial crimes. Financial market participants are diverse and play different roles in ensuring the proper functioning of the market. These include investors, brokers, asset managers, issuing companies, investment banks, and regulators. By understanding the different roles of financial market participants, investors can make more informed investment decisions and take advantage of market opportunities. Part 5. The importance of regulation in financial markets. Regulation of financial markets is a very important issue in the global economy, as it is essential to ensure the stability and integrity of the financial market. Regulation refers to the set of laws and regulations that governments and other entities establish to control the conduct of financial market participants, including investors, brokers, asset managers, issuing companies, and investment banks. Regulation is important for several reasons. First, it helps protect investors and consumers from potential fraud and dishonest practices. For example, financial regulations establish requirements for information disclosure and transparency in market operations, which helps prevent investors from being misled by false or misleading information. Second, financial regulation helps maintain financial market stability. Financial markets can be highly volatile and can be prone to financial crises if not properly regulated. Financial regulation can help prevent financial market collapse by setting limits on excessive risk-taking and preventing market manipulation. Third, financial regulation is important to promote fairness in the financial market. Financial regulations can establish disclosure and transparency requirements that help prevent discrimination against certain groups of investors or firms. They can also establish requirements for diversity on boards of directors and management teams, which can help prevent unconscious bias and promote fairness. It is important for financial market integrity. Financial regulations establish sanctions and penalties for unlawful conduct and help maintain public confidence in the financial market. When illegal or unethical activities are detected, financial regulations can impose fines and criminal penalties on financial market participants, which can deter others from committing similar offenses. Financial regulation is essential to ensure the stability and integrity of the financial market. By setting limits on excessive risk-taking, preventing market manipulation, and protecting investors and consumers, financial regulation helps maintain public confidence in the financial marketplace and promotes fairness and equity in the marketplace. As a result, financial regulation is an important tool for maintaining a strong and healthy financial market. Part 6. The influence of the economy on financial markets. Financial markets and the economy are closely related, and the influence of the economy on financial markets is significant. The economy influences financial markets in a number of ways, as economic movements can directly or indirectly affect financial markets and investors. In this article, we will explore some of the ways in which the economy can influence financial markets. First, the economy can influence financial markets through monetary and fiscal policies. Monetary policies, such as the interest rate, directly affect financial markets, as changes in the interest rate can affect the cost of borrowing and the profitability of investments. Fiscal policies, such as taxes and government spending, can also indirectly affect financial markets, as they can affect economic activity and economic growth, which in turn can affect investment returns. Second, the economy can influence financial markets through economic trends. For example, the economy can experience sustained economic growth or recession, which in turn can influence the prices of stocks, bonds, and other financial instruments. During an economic recession, financial markets may experience a decline in the value of stocks and other financial instruments, as investors may feel less optimistic about the economy and corporate prospects. Third, the economy can influence financial markets through geopolitical events and economic downturns. For example, a geopolitical event such as a war or political conflict can affect the economy and financial markets, as there may be disruptions in international production and trade. Similarly, an economic crisis, such as the 2008 global financial crisis, can have a significant impact on financial markets, as there may be a decrease in investor confidence and an increase in market volatility. In conclusion, the economy has a major influence on financial markets and investments. Economic movements, monetary and fiscal policies, economic trends and geopolitical events and economic crises can directly or indirectly affect financial markets and investors. Therefore, it is important for investors to be informed and closely follow economic trends and current events, as they can have a significant impact on their investments and financial future. Thank you for watching this video. I hope you found the information useful and entertaining. If you liked this video, be sure to like it and subscribe to our channel so you don't miss out on future content. See you in the next video.